it may be that the Fed cannot solve this problem. So if I lay it out as a proper mathematical formulation, it may be that there's no solution. There was a solution when inflation was low and growth needed to be pumped. Now there's no solution because inflation's high, growth cannot be trashed too badly, and growth gets hit first. And I think in 2016, Janet Yellen gave a speech where she said that there are three components to inflation. The first component is trend. That's a long-term thing. The second component is...
What is trend, Harry, as Janet Yellen used it in that speech, in your interpretation?
It's the long-term. By long-term, I mean the 1 to 5 year expected change in inflation. And the Fed's preferred measure is the PCE rather than the CPI, but it doesn't matter too much. As anchored by expectations. So the University of Michigan has an inflation expectations index over various horizons. And the belief is that if the Fed has solved the problem of inflation, as they have taken credit for many times, then even if inflation sort of pops up a little bit, oil prices spike, this, that, and the other, it's not a big deal because corporations and individuals won't adjust their behavior so much to the so-called transitory changes because they know or believe that the Fed will be able to adjust over time. So that's a bit of a confidence trick, but yeah.
So this first piece is the sort of longer-term structural rate that Chair Yellen was discussing.
Yes, and so moving from the longest tenor or the longest horizon to the shortest one is can be proxied by fluctuations in oil prices, commodity prices. And The idea there is that, well, if oil spikes, Fed doesn't have to do much because it's going to come down quickly. Market forces or, capital market forces will push it right back down again. So the real thing that the Fed on record has been concerned about is the output gap. Again, this is a thorny macro term, but what the output gap means...
And just to frame this is the intermediate term. So you've got the longer term trend rate, you've got the short term rate around commodities prices, sometimes called exogenous shocks. You hear about negative exogenous supply side shocks in the fancy economic term whenever you see oil prices spike. And now what you're dialing into is the medium term cyclical component of inflation.
Yeah, the cyclical component, as the Fed defines it, is related to something called the Phillips Curve. What the Phillips Curve relates is the output gap, which can either be interpreted as the level of employment or unemployment relative to target. There's some natural level that is God-given for employment or unemployment. It relates employment to inflation, or similarly, it can be used to relate excess growth to inflation.
So this intermediate term is all about the business cycle that we're talking about. We sometimes hear NAIRU, this is the non-accelerating inflation rate of unemployment, R-star, all of these terms that talk about the cyclical nature of where the economy is right now and those imbalances that occur as the business cycle moves.
Yes, exactly. And before I get skewered for saying all this, what I'm trying to do is spell out the way the Fed thinks about inflation rather than the way that you or I should think about it. Now, continuing on that theme.
And that's important because this is, from a control theory perspective, your analysis is talking about the reaction function of the Fed. So it's important to understand how they think about inflation, whether or not one agrees with it, because that is the basis that they're using for conducting monetary policy, adjusting interest rates, expanding, contracting the size of the balance sheet.
Exactly. So it's a bit like, as an investor, the viewership or everyone out there isn't in the position of watching a satellite land perfectly within 100 meters of target on Mars. Instead, what they're viewing are the hopeful but perhaps effective or ineffective attempts of an organization, a government-influenced organization, to control the path of the economy in a way that may or may not work. So we're actually observers of some process that may or may not work. But we need to know what the process is, and we need to know what the controls are before we can say anything meaningful about it, instead of having the conversation devolve into the Fed are idiots or the Fed governors are geniuses. I think that's a discussion I've heard a lot. I understand it. I get emotional about stuff too, but I don't think that that's the point that I want to make today. So, in any case, according to the Fed's view, monetary policy can affect this output gap, this trade-off between inflation and growth. And that's where it's directed. So if oil prices go from $50 a barrel to 120, and I believe that this is the Fed's model, if that's what I've inferred, then the Fed's not going to do anything about it, at least not short term. And they will apply words like transitory to it. If the output gap becomes a little bit punitive, in other words, if growth is above trend or employment is above target, more accurately, maybe the Fed does nothing again. They'll call it transitory, because they still think that as long as the confidence trick works, which is that corporates and retail believe that the Fed will ultimately control inflation, then they can continue putting that label on it, hoping that the trend will reverse.
You know, Harry, you've got a really nice chart here called Likely Fed Model of Inflation that visually shows some of these points, the difference between long-term trend growth, the business cycle, and energy price cycle. Let's put that chart up there, and perhaps you could walk us through what we're seeing.
Well, the first is trend, inflation trend, again, which is supposedly tethered to inflation expectations. The second term is this output gap, or this Phillips curve trade-off between employment levels and inflation levels. And the final term is just kind of this sharply mean reverting random shock thing that has to do with oil prices. Now, this is stolen from the good people at nowcostingeconomics.com, based in London, so I thank them for that. Now, the crucial thing here is something that I think has been mentioned by other people, but I'd like to emphasize it again, which is that when inflation expectations become unanchored, then there's a problem. And if you look back as recently as May of this year, what you saw was that inflation expectations coming out of the University of Michigan came in at 5.3%, which I believe is the highest since the early 1980s. That can no longer be viewed as transitory inflation if you believe the Fed is thinking the way that we've spelled it out. So if they believe that the trend component is more meaningful than the other two, and that monetary policy really can only deal with the second component, kind of the economic cycle piece, they must have panicked at that point. So I think when expectations started to come in high, which didn't just happen in May, but it really was a significant number in May, that's when the imperative to act became strong. Again, are they doing the right thing or the wrong thing? No judgment there, no value judgment. It's just that if that's their model, they had to act quickly, or they felt they had to act quickly. But now they're faced with a serious problem. And this is kind of one of the main things I want to talk about today, which is that historically, if you look cross-sectionally over central bank interest rate policy, you'll find something interesting. Namely, that the time it takes to affect a growth or affect GDP or output or employment, whatever, is less than the time it takes to temper inflation. So what does that mean in practical terms? It means that the Fed may have been taking a victory parade dance as growth stalled but inflation was structurally low, for reasons that I can discuss, over the past few decades, simply because if they eased monetary policy, if they became more dovish, if they cut rates, if they expanded their balance sheet, they could stimulate growth more quickly than inflation would be affected. So in other words, they could get growth back to a reasonable level, they could stimulate the economy, they could free up the credit markets without triggering too much inflation, simply because the transmission lag between policy and growth is shorter than the transmission lag between policy and inflation.
Harry, I want to double click on this for our viewers because this is such an important point. This is what's new. This is what you're bringing to the table. Everything that we've just discussed up until this point is something that's fairly well known in macroeconomic circles, in market circles for people who follow macroeconomics. But Harry, this really is your key insight. This is the new piece. This is where the control theory comes in. This idea that these different policy objectives effectively happen on different time cycles, which creates significant problems, in fact, significant risks for the broader economy itself. Such a key point.
Yeah, I mean, the one point that I've left out is that when the Fed conducts policy, obviously they have a dual mandate, but they also have a loss function. The loss function is how far has growth moved away, let's say, from target growth, plus how far has inflation moved away from target inflation. So if they start hiking rates, then yes, inflation will come down eventually. I suppose they could always engineer a drop in aggregate demand or a drop in the availability of credit at a good price. But assuming that what I say is correct, that the delay is shorter, the transmission lag is shorter between smashing growth and tempering inflation, they're going to hit their loss function earlier than the market did think, probably 2 or 3 months ago.
Could you define loss function for folks who may not know?
It's a good question. In control theory, you're trying to achieve an objective at limited cost. So if I want to drive to New York from where I'm hanging out now, yeah, I'd like to get there quickly, but I don't want to spend too much by, burning through my gas tank or whatever the phrase is, by using too much energy along the way.
Right.
So there's a cost. And for the Fed, having read a lot of Fed documentation and other central bank documentation, there is a loss function. And the loss function basically says, how much pain is the Fed willing to take for its constituency in the process of conducting its monetary policy? So usually it's, or historically over the past few decades, it was how much can we cut rates without unleashing the inflation genie? Now it's turned on its head.